I do like founders that have a strong point of view.
Yeah.
They don't need to have a strong point of view on everything, but there's like one thing they believe. Preferably, it's not something the world believes. They have this kind of unique point of view.
Welcome to NY Seed Round, the podcast for curious startup founders.
I think you need to kind of keep VCs a little bit arm's length until you're totally ready.
In each episode, I dive deep into the learnings and mistakes made by the world-class investors and operators who have helped make the New York City tech ecosystem what it is today. What are the other qualities that make you on the other side of the table be like, I want to invest in this person like tomorrow? This week, I speak with Hadley Harris. He's a founding general partner for ENIAC Ventures and a prominent VC in the New York City ecosystem. As a VC firm that's uniquely started by former founders, ENIAC Ventures leads seed rounds and partners with founders to help them establish product market fit as fast as possible. We talk about investments ENIAC has made, what he's learned from that process. Lastly, we cover ENIAC's unique definition of product market fit and what the ramifications of it are for founders. Hadley Harris, thank you for joining me. I'm really excited for the conversation.
Thanks, Justin. Happy to be here.
So before we kick off, there are a couple things I want to talk about: your history with mobile, your investment thesis, how you think about working with founders. But first, could you give us sort of the 2 to 3 minute story of your journey to where we are today?
Yeah, so grew up in Boston, was really into math and science, actually was very poor at everything else, so that made sense of what to go into. I studied engineering at Penn, and kind of the important part of that was that's where I met my co-founders of ENIAC. So we're all engineering students, became friends. Afterwards, worked as a developer for a few years, managing engineering teams, so much more on the building side. Went back to school for business also at Penn. Bounced around to some big companies, kind of figuring out what I was going to do next. I was a product manager at Microsoft, went over and became a kind of a strategy group within Samsung, and realized that like big companies just weren't for me. That was in Korea, came back to the US, started meeting startups, meeting VCs, kind of figuring out what I wanted to do, and got linked up with the guys at Charles River Ventures up in Boston. They just made a seed investment in an MIT spinout called Vlingo. There was a very early kind of AI company, voice-based assistant, this is before Siri. Ended up jumping on with those guys and building out that company. Amazing experience. We built that for 4 years, were acquired. That technology got folded into Siri. Then moved to New York and became chief business officer in another venture-backed business called Thumb that SoftBank and General Catalyst had invested in. We got acquired about a year and a half later, so it's kind of a shorter stint. And kind of during that time was talking with these old friends of mine about, maybe we want to get into VC.
Right.
I don't think we want to kind of work our way up with, especially back then it was like an old boys network. And we really realized we all loved the early stages of building companies, and can we focus on that? And this is kind of when seed wasn't yet a thing. We raised a very small seed fund from kind of friends and family and started investing, and founders seemed to like working with us, and we've been building it ever since. So we've now been investing for 14 years. We just raised and started investing out of our 6th seed fund. It's been off to the races since.
That makes sense. All three of you were really successful operators. How did each of you avoid the bug of wanting to go start another startup?
Yeah, that's a great question. I think if I had joined a big multi-stage fund, I probably wouldn't be doing this 14 years later. I probably would have gone back, or some sort of hybrid situation. I think building your own firm, we have 14 employees. We're kind of building our brand. We're thinking really long-term about what we're building. I think that kind of scratches that itch a bit. I see my role as actually a little bit more of a hybrid between a founder and a VC. Maybe that's just what I tell myself, but yeah, it feels that way.
Is that the unique nature of being a seed stage investor versus maybe further along?
I think it's a little bit about that, but it's actually, I think, more about being a founding GP versus an employee or someone who joins the firm. If I had joined Sequoia or a firm like that that's been around for 50 years, would feel much more like an employee versus kind of building your own firm.
Got it. Now, you started ENIAC. You've made investments in companies like Airbnb, Fungal, but one of your portfolio companies was in the news this week as a Forbes top 100 cloud company, Attentive. Tell me about the story when you met the founders and what made you invest.
Yeah. So I originally met Brian and Andrew a few years later. Actually, we were the first investors in their prior company called Tap Commerce, and I was on the board there. And that was a great ride. We got acquired pretty quickly. They sold for about $100 million, about 2 years. Not a huge outcome, but especially this is our early days, it was
Yeah.
a good outcome for everyone involved.
That's an early win. You're like,
Early
okay,
win,
this
yeah.
thing can work out.
Yeah, it was actually real liquidity given
Yeah.
our fund was so small. But during that time, just saw like the high level that they were operating and how quickly they were iterating and learning. So it was definitely like, okay, when they leave Twitter, I want to be first in line. So I was lucky to kind of hang around the hoop. And when they started a new company, we started chatting about that. The first iteration was a little different from what Attentive became. But so we actually made the investment, like, I think of seed investments as kind of a spectrum between a pure founder bet and a more thesis-oriented bet. This was like pure founder bet. Like, we just knew that Brian and Andrew were going to crush and figure something out. And the idea was good, but we weren't too focused on that. It was really all about them. And that came to fruition. They're just incredible operators and built a company that grew extremely fast.
Have you learned anything in the process of backing that company and then just your journey with them that you think makes you a better investor today?
Yeah, in particular from Brian, he went out and even before they started building product, talked to over 100 potential customers and just getting information out of them. And I think this has become more common, but at that time, this was back in 2014, it wasn't quite as common to take that approach. And so that really kind of sunk in with me and something that I pushed a lot with founders I work with. You just can't talk to enough customers. And not just trying to sell to them, but trying to extract as much information around their problems so you can think about what you're going to build. So that's something definitely kind of sunk in with me.
Based on your responses there and then having success with companies like Airbnb and Attentive, how do you manage like raising the bar of companies that you'll invest in today, but not giving too much of a standard, like you have to become, like you're not going to meet the founder of Airbnb every day?
Sure.
How do you limit that from, impacting potential founders that you'll invest in today?
Yeah, it's hard because, every investment we make, we have to believe can be a huge company and be a fun returner. Right. For better or worse, that's how venture works, certainly at the early stages. It's a hits-driven business. Most startups fail one way or another, and we need to be able to make up for those with kind of really big wins. So we try and keep the bar really high. I think the interesting aspect to your question is not every company is founded by a repeat founder that's really late in their career. There are a lot of great companies that were founded by folks that were early in their career. And the question is trying to identify those also and find those folks that we can invest in that are really talented, but maybe a little early, but also kind of thinking a little bit broader and kind of attacking problems in a new way.
So you're over a decade in, very successful as a VC firm, especially here in the New York City ecosystem, which I love. What do you wish the three of you had known when you were early in your journey starting ENIAC? Before we hear their answer, I just want to take a moment to thank everybody for being a part of the NYC round journey since we got started earlier this year. For more founder and investor-driven content, like and subscribe. Now back to the interview.
We didn't really have experience working at a big firm. I had done that little stint. My co-founder Vic had spent some time at RE, but we basically have taught ourselves how to be VCs. And there's advantages of that as we've tried a lot of new stuff over the years and most of it hasn't worked and we've learned from that. If I went back, I probably would have tried to have a little bit more DNA in the founding group that had spent time at successful firms that could kind of bring that knowledge to us. We probably would have made less mistakes if we had a little more, someone had come from a Bessemer or a CRV or Excel or something like that.
Is that everything from what to look for to just basic operations or?
Yeah. I mean, we just did a lot of stupid shit in the early days, I think it took us a while to understand the value of ownership. These are very simple things that, I think very early on, we thought maybe we could, what I'd call double your way to success by a company that, they're definitely going to sell for 60 million and we'll make money on that. We'll just do a lot of those. As I said, it's a hits driven business.
That's
so
right.
A lot of learnings like that we probably could have short circuited.
That makes sense. So this conversation started because I saw a tweet a couple weeks ago and I just wanted to talk to you a little bit more about the sentiment behind it. You said something a lot of founders don't seem to recognize is that VCs are incentivized to act super interested until the millisecond they decide to pass. What are the implications of that for founders?
Yeah, because I've seen this a lot over the years. I think probably the most common mistake that founders make when they're raising money is they get a little overconfident. Their assumption around the conversion rate of the VCs they're talking to they think is just much higher than it really is.
Yeah.
I mean, you have to remember each VC is meeting hundreds of companies every couple of months, and maybe they invest in one, often zero of those, and that caused them to talk to less VCs than they would expect, kind of overestimate where they are in that process. So, one of my jobs is helping our founders raise their follow-on round. So that's one thing I'm kind of constantly trying to hammer into them. They go with the meeting, they come back, and they're like, "Oh, and great, I think they'll probably convert." It's like, and in their mind, it's like, well, this is like a 50-50. And it's like, this is like a 3% chance.
3%.
And you just got to kind of keep that in your mind, because unfortunately, they can lead to mistakes through this kind of being overconfident. So that's what I meant by that.
That makes sense. And earlier in your career, you started as an engineer, and Harry Stebbings has asked you about how that impacted how you view investing and your skill set there. But I'm also curious, how does it impact how you evaluate technical co-founders that are trying to raise money from ENIAC?
Yeah, I don't know that it helps that much, like evaluating the CTO. I tend to vibe a lot with the CTO, which I think is certainly helpful in competitive situations. I think evaluating a CTO this day and age is like above my pay grade to a certain degree. I'm very dated. I haven't like pushed any code to production in 16 years or something like that. Right. So I'm definitely not going to be able to like understand the depth of what they're building at like a granular level. I think where it really matters more is, again, with that relationship, but also just kind of understanding more at like a systems level what they're doing. So I tend to take kind of a opposite approach as I think most VCs. When I meet a team, I usually start with the product at more of a systems level, how it works, where the data comes from, where it touches different stakeholders. And then when I feel like I really understand that, then I kind of move on to the business aspects. I think just seeing other VCs take pitches, they tend to go the opposite way. They start with the business, and they may not even really get into the product for the first meeting or two. They'll decide, is the business worthwhile? And then at some point, they're like, well, let me actually understand how this thing works. I think my engineering background is kind of the reason I feel it really important to understand how it works before I kind of get into that. And I feel like it's hard to understand the business if you don't understand how the product works. So I think that's really kind of impacted me from that perspective.
Well, what are some risks of taking that business first mindset versus digging into the product like you take as an approach?
I'm biased because I take the approach I take, but I feel like you can have a lot of blind spots around how the business even works when you're not thinking about, okay, how are all these stakeholders, customers, partners, data providers, and how are they interacting with the product itself? Like you're kind of just, I think you have a very surface level understanding of things, but if you actually understand kind of how they're interacting with the product and the true value of the product, I think that gives you more depth. I've only done it this way, so it's hard to say if it's helped me avoid mistakes or make better decisions, but at least to me, that's how it feels.
That makes sense. What did your stints at Vlingo and Thumb teach you about building a startup?
Yeah, I mean, the hardest thing is it's really, really tough, and there are a lot of great VCs who never built startups and they've done a great job, and I have a lot of respect for them. I would find it really hard to have the true empathy that I feel like I've had. Even Vlingo, which from the outside appeared to be, we always raised money, we always raised at a higher valuation. We were acquired at the time, was quite a good exit. This today would be kind of smaller, I think. For the outside, that looked like just easy up and to the right. And the reality is shit went down all the time. We almost ran out of money several times. We had to do a bunch of layoffs. There was politics to deal with. And I think that's given just me a lot more appreciation to how hard it is to be a founder, how hard it is to be those early employees and build a company. So that's really impacted me. I think the other thing that's really impacted my current job is for both companies, I was in charge of fundraising. So I was going up and down Sand Hill Road. I pitched every big fund you've ever heard of. Most of them passed. Yeah. Also, I think VCs in general have gotten better, but saw some really bad behavior. And there's a lot of situations we were in where the guy would go and have lunch during the pitch or just be talking on the phone while we're talking. It's should we keep talking or I'm not really sure what's not there. I'm not really sure what to do here. Whereas okay, I'm definitely not going to do that if I'm ever a VC. So that's been really impactful for me.
So what is on Hadley Harris's guide to pitching VCs then? If you were to write, you had a blank piece of paper, 3 to 5 things you would make sure every founder knows about the process?
Oh, geez. I mean, one is just be really prepared. Like, I think a lot of founders kind of rush into the process or kind of fall into the process, whether it's their first round or later round. You know, some VCs show interest, and then they're all of a sudden they're in this process. I think you need to kind of keep VCs a little bit arm's length until you're totally ready. There's a lot of, there's different schools of thought on this. I tend to be on the side of not doing like coffee chats with VCs when you're not raising. It can work in your favor, but I think more times than not, like, you don't have your shit together. You don't put your best foot forward.
Focus on building the business.
Focus on building business and then talking to them when you're ready. Because you're not always thinking about your story for fundraising. That should be aligned with what you're building, but it's a little bit different, and the way you package it can be a little bit different. So talk to VCs when you're like totally ready, and you've like practice with your insider investors or your friends or whatnot. So that's a second thing. These are probably the two big things that come to mind. Yeah.
I imagine, like most things, you being on the investor side of the table, meeting with a founder who's a seasoned second time, third time versus a first time, you notice differences between the two. What are the most common things that you notice?
Yeah, probably the biggest thing is that second time founders, I think, are a lot more transparent about what they know and what they don't know, and a lot more cognizant of the fact that it's really hard to predict the future.
Yeah.
So when they talk about the future, it's like, well, how does this industry kind of look in 5 years or 7 years or whatnot? They'll be like, it's really hard to tell.
Yeah.
Here's my hypothesis of what I think it looks like. And here's like what I'll be keeping an eye on to know how that will actually end up. A lot of times, first-time founders, I think when they're pitching, have this notion in their head that they need to have all the answers. So they'll have this like, this is what it's going to look like. And it's like, that's not how the future works. The future is very hard to predict. And hopefully there's something that you have a unique point of view that you're right about, but you're not going to be right about everything. It's going to be how you react to a changing environment.
That makes sense. Actually, one of your essays, you wrote, it's something that I see that's very different between the two. First-time founders that have done it before tend to be much more open about what they don't know. You know, they'll talk you through how they're thinking about it. A lot of first-time founders want to pretend like they know everything when the reality is that's never the case. You know, talk me through what should a first-time, because I feel like the founder should be the person who's like the ambassador for what they're building, but how do you mitigate like overselling when you're trying to win investment from a VC?
Yeah, I mean, I think there's certain things you need to know. Like, you need to know as much as possible about your customer. You need to know the market you're going after. There's probably some, unique advantage you have. You need to be cold on that, but you don't need to know everything.
Yeah.
You know what I mean? Again, like, and certain things are just not knowable. Like, that's one thing about early venture. That's why it's so hard, and why startups are so hard. Is there's a lot of unknowable information, and I think being kind of transparent about what you know and what you don't know, and again, kind of get into the way you think about that in an honest way, which is the hypothesis and then what you're gonna like test over time. I just think that's a lot more authentic, and it's just aligned with what success looks like. We were talking about Brian at Attentive, like, he went and talked to all these customers because he didn't know, and he wanted to know like exactly what their pain points, and he learned a ton from that. I think just being kind of honest about things like that is what I see in really strong founders.
If you control for things like, they admit that they don't know, or, the fact that most startups will, when you're investing at the seed stage, will not end up where they started in 5 years. Like, what other qualities? You mentioned talking to a bunch of customers. What are the other qualities that make you on the other side of the table be like, I want to invest in this person like tomorrow?
Yeah, it's a balance, because in this some ways is a little maybe counter to what I was saying. In some ways, I do like founders that have a strong point of view.
Yeah.
They don't need to have a strong point of view on everything, but there's like one thing they believe, and preferably it's not something the world believes. They have this kind of unique point of view on something that they want to make happen, and they believe is going to happen in the future, and they're going to make risky bets to do that. As a early stage investor, we don't need every company to work. We need the ones that work to work really well. And if they're just kind of following the herd and doing what everyone's doing, it's not going to work that well. So I look for kind of risk takers that have these kind of unique, strong points of view, but they're always kind of challenging their own point of view. Or I actually had a founder recently, which I really like, say, he's like, I have a very strong point of view. This is what I want to make happen. How I make it happen, I'm not, as focused on. I'm really kind of open to different ideas and to outside, influence on that. So that type of thing is something I tend to look for.
In another recent essay, you wrote about qualities that you look for today, and one of them is like creating switching costs. That feels much more difficult today with generative AI being the way that it is. Like two kids, like in a garage, can probably copy an average SaaS platform today. How do you, first question is, how do you evaluate generative AI investments in this sea of sameness? And then two, how should founders think about creating switching costs today, given the current environment that we're in?
Yeah. I was lucky to I got kind of into generative AI before ChatGPT came out. So I made some investments, and it was like great back then because it was like not everyone was doing it.
Right.
And the thin wrapper actually would grow really quickly and there wouldn't be competition. Obviously that's changed a lot in the last 2 years. Yeah, there's a couple things we think about it, and I'll kind of focus more on application layer stuff for this.
Sure.
We've been spending more time, and I spending more time, which is abnormal for my background, on more like vertical solutions. I just think there's a much better opportunity to defend those areas. It's much less likely that, a big player like a Microsoft or OpenAI is going to go into them. I'd say the opposite of that is things that involve kind of knowledge workers. I just worry a lot of that's going to get swallowed up by big players that are going to have these kind of agentic solutions to do everything. But within kind of certain verticals, feel much better about that. You can actually build a proprietary data set that's not going to be crawled by kind of these large LLMs in the future. So that's one area. And then if you are doing something within that's more horizontal, having it be somewhat niche and kind of off the beaten path, very focused area, if possible, again, something where the usage is creating a data set that's not public, so you can have some sort of kind of proprietary training there. Where possible, automating really complex workflows that kind of touch a lot of different areas, again, that would be difficult for kind of an outsider to try and work on. But at the end of the day, a lot of it is like, can they have like some of the old school things? Can they move faster? Can they have the best go-to-market? Not trying to rely on kind of the generative AI aspects of it to be kind of different. In fact, it's, as you mentioned, it can kind of work against long-term differentiation. So sometimes you just win by kind of moving faster, having the best brand, having your customers love you. Sometimes there's some kind of switching costs that can get built into the way that you use it, for example.
It almost feels like product roadmaps have to be like months long or weeks long now, instead of like the 3-year or 10-year product roadmap.
Totally. And yeah, the crazy thing is, like, even look since ChatGPT has come out, there's so many new models that have come out, and the abilities of those models have changed so much that if you plan too far in the future, you're not going to be utilizing the latest abilities. I think you saw this with like multimodal models. Like, you had all these companies kind of like, oh, we're going to do text, and then we're going to stitch together some visual stuff. And it's like, no, now you just give the whole thing to one model, or one ensemble model, and it kind of sends it back.
Got it. That makes sense. You've also written about sort of one person takes the entire market, winner takes. Do you still ascribe to that thought that in competitive markets, it is generally the leader who takes the entire, or a good chunk of the pie?
I think with vertical stuff, it's mostly common for one player to take the mass majority, almost all of it. I think in some markets can actually almost take the whole thing and kind of pull it.
So you think it's relevant on the industry level too?
That's right. I think horizontal, I think it's less common, but I still believe that it's like a winner take most, or maybe the very long term, it turns into an oligopoly.
Yeah.
I think you see something like, an example would be like CRMs, for example. There are actually quite a few CRMs, but like a couple of them really kind of have most market share.
I read that you and your partners have leveraged a professional coach at times. What have you learned from that practice?
Oh, a ton. So I use coaches at both my startups. I'm a big fan of utilizing, professionals. To me, it's like, the way that teams work together, both at a VC firm and a startup, is so important. Communication patterns are so important. Why would you not want someone in the mix who's third party and thus is not kind of part of the team, but does this for a living? You don't just like trying, you hire professionals for your CTO and your head of biz dev. Like, why wouldn't you do the same in terms of those team dynamics?
You really cut your teeth with mobile, though. What's the state of mobile? And tell us about your journey investing in it.
Yeah. So, if you look back at the old press releases when we announced, when we started in 2010, we focused entirely on mobile because that's what we believed was kind of the next evolution of computing. And part of that, I think we all kind of came to that independently, but I was working for Samsung in Korea. This is 2006, 2007, so a long time ago. And they actually already had 4G networks in Korea. We were still on 2G in the US. So they had these like dumb phones with big screens, and I saw how people were using them. They weren't quite surfing the internet, but they were doing a lot of stuff. There's a lot of kind of text and games and stuff like that. And I was like, all right, this is really cool. And then Steve Jobs came out and announced the iPhone. And I was like, okay, wait, now you can have the internet, and you kind of have this bandwidth's eventually going to come to the Western world. So that was, at least for me, I was like, okay, this is the next thing. So I pretty much kind of bet my whole career at that point on mobile, and joining Vlingo was kind of a bet on that. They had figured out this way to have a voice conversation with your phone, so thus it could be an easier interface. So that was kind of the evolution of that. But, it still took time back to like talking about AI. Like, Instagram came quite a bit later. Uber came quite a bit later. Those really big companies that were enabled by mobile. So yeah, again, like the idea that like everything's going to change in less than 2 years, I think is kind of crazy.
One other aspect of that that's fascinating to me is that like you invested in Airbnb. There were like businesses that pitched the Airbnb idea, but GPS wasn't around yet. Yeah. Like it's almost like the right time and right place. So yeah. I always think about that today. Like, what are the startups today that are pitching something that isn't right for today, but is right 5 years from now?
Totally. I think if you look at all these types of companies, there were, I remember seeing like Uber type stuff, but the GPS wasn't good enough. And I think there's a ton of examples like that.
Yeah, makes sense. The real reason I invited you here is because you're from Boston. I have to know, do you think it was Tom Brady or Bill Belichick?
Yeah. Of course, it was like the combination of the two, and this is probably less little bit against the grain. But I've always thought that Belichick was more of the driver of the entire kind of dynasty than Brady. That doesn't match what you kind of saw since then. I think there are some reasons for that, but I tend to be a little bit bigger of a Belichick fan than a Brady fan.
Gotcha, makes sense. Well, Hadley, thank you so much for coming by. I've learned a ton in the conversation. So
thanks for having me. It's been great. Thanks.